Thank you very much indeed. And thank you, Honourable Minister, Ambassador, CEO of Malaysian Palm Oil Council, Director General of MPOB, a very distinguished audience, and thank you many people from Vietnam. I'm going to talk today about what is usually the first subject people mention when discussing any commodity, which is price. So I thought I would try today to give you some clues about how my colleagues and I understand and analyze vegetable oil prices. And obviously I will talk mainly about palm oil. So I'm going to explain, and by the way, you can get copies of all the presentations on the MPOC website later. So if you cannot take notes, doesn't matter, you will get a chance to see them from the website. So I'm going to explain how the factors determining price have changed since 2007. I will show you that. And I'm going to show how the influence of stocks on price has changed. And the thing which I really want you to learn after today is that palm oil is now part of the petroleum complex. Petroleum and palm oil are very closely linked. A recent development has been export taxes on palm oil in Indonesia, and this year also Malaysia. And so I will mention that. I'm going to show how palm oil prices being strong has increased the supply in particular from Indonesia. And then I'm going to end up by giving you some quick lessons for you to take about how you can do your own forecasts of palm oil prices. So I'm going to do a lot of things today. So I'm first going to show you how things were up until the end of 2006. This diagram here shows you European Rotterdam prices in US dollars per ton. The blue line on your screen at the bottom is crude oil, is petroleum. The yellow line is palm oil. The red line is soybean oil. The green line is rapeseed oil, canola oil, they're the same, rapeseed canola. And the black line is sunflower oil. What I want you to see is that there was no connection of any sort between crude oil and the vegetable oil prices. They did not move together. You also see that palm oil, crude palm oil, CPO, was the cheapest oil. And that is how palm oil was gradually able to capture markets from other oils. When you were trying to forecast palm oil prices at that time, it was fairly straightforward. What my colleagues and I used to do was look at the changes year on year in stocks, which in this diagram are in red. These are stocks in Malaysia. And you can see that the changes in blue year on year in price went in the opposite direction. So it was fairly simple. Higher stocks, rising stocks meant lower prices, lower stocks meant higher prices. That was how we used to forecast price, up until the start of 2007. So, until 2007, Malaysian stocks were the key determinant of world vegetable oil prices. And palm oil is the key oil. It is the biggest oil, as you will see in later presentations, biggest oil in world production. It's much more than half of all exports of oils. So it is the leading oil. Where palm oil leads, the other oils follow. So you could say that Malaysian stocks were the key driver of the prices of all the vegetable oils around the world up until 2007. And the reason we use Malaysian data is the Malaysian Palm Oil Board publishes very good statistics every month. On the 10th of every month, they publish the previous month's stock figures. So the world looks at those numbers. We do not have any good numbers for Indonesia, even though it is a bigger producer. So everybody follows what MPOB publishes on stocks. But we are now in a new world. We're in a new world hotel, and we're in a new world for palm oil. And I will show you the new world. This is the same price diagram. I include again 2006, but I draw a line to show you when 2007 begins. At the bottom, in blue, again we have crude oil. This is what is called Brent, North Sea crude. It's really the world price for crude oil. Then in yellow, you can see, it's not so clear, but yellow is palm oil. Red is soybean oil. Green is rapeseed oil. I hope you agree with me. When you look at this, this is a completely different diagram. You see we are in a price band. Crude oil, petroleum at the bottom, and you see that recently palm oil nearly touched the price. It actually did touch the price of crude oil, but it never really went below. We have petroleum at the bottom. We have rapeseed and soybean oil at the top, and you can see palm oil is bouncing in between. I hope you agree there is a price band. I have just quickly drawn some lines here to give you an idea of the price band. This is different. This is completely different from before. This is why I say we are in a new world. And what I then ask myself is, what is the influence of stocks? Because we can no longer really say that stocks are driving prices. And this shows you why I cannot say stocks are driving the price. This is updating the diagram I showed you before. Maybe you remember, earlier I showed you, stocks go up, price goes down. Stocks go down, price goes up. Sometimes stocks go up and price goes up, which is not logical. Sometimes stocks go down, price goes down. It depends. There is not a good relationship. That is because we now have crude oil at the bottom, setting the floor to the price band. So this is a very important lesson when you are trying to forecast palm oil prices and vegetable oil prices. You must remember that since 2007, the forces that determine vegetable oil prices have changed. They now are part of the petroleum complex. Actually, to understand palm oil prices, you must also become a petroleum economist, because until you know what petroleum will do, you cannot predict what palm oil will do. And we see that the prices of the main oils are trapped in a cage that links them to petroleum. And I say here, the price that is used is Brent North Sea crude oil. I say that because sometimes people talk about the price inside United States, which is quoted on markets in New York. Brent is a much better guide to world prices, and what is interesting is the price in this region, Southeast Asia, which is usually quoted in Singapore, is virtually identical to the price in Europe. So Brent is a very good benchmark price for petroleum. And it is very important because Brent sets the floor to the price band. And I mentioned at the bottom there the prices of the other two big oils, which are soybean oil and rapeseed oil. When you look at the diagram, you see they move very close to one another, and they fluctuate within the price band by less than palm oil. The gap between them and petroleum is more stable than the gap between palm oil and petroleum. And this diagram shows you that gap. It shows you the premium. It shows you how much the price of vegetable oils was above. This is monthly prices. How much the prices were above petroleum. You can see here I do rapeseed oil is blue, soybean oil is red, palm oil is yellow. And I've drawn 3 horizontal lines. Purple line is the average premium of palm oil over Brent crude oil since 2007. Green is the average premium of soybean oil over crude oil since 2007. The yellow horizontal line is the average premium for rapeseed oil. What you will see is all of the oils today have a smaller premium than average over crude oil. They are not even up to average. But the one really to look at, because we are talking about palm oil today, the one to look at is the palm oil one. That really has bounced. And what you see is actually in December last year, very briefly, it went just below 0, but then it bounced back. The floor was tested, but it then bounced back. They never went right through the floor. And this was the best test you could ever have, because world palm oil stocks in December were at their highest level ever. But even so, that floor of 0 was defended. And I now want to explain to you how that was defended, because you need to be persuaded by me if you accept my argument that crude oil will in future set the bottom of the palm oil price range. Now, before going into more detail about petroleum, a good question is, in the new world, what is the role of palm oil stocks? Because the market every month looks at stocks. And this is, to me, a lovely diagram. I show you here, in red, the monthly stocks that are published by Malaysian Palm Oil Board. You can see they touched their peak at the end of last year. That's the red line. That was the highest peak they have ever reached. And now they've been coming down. The blue is the premium for palm oil over petroleum. And the yellow is the average level of the palm oil premium. And that premium is measured on the left in dollars per ton. I hope you agree with me. When you look at this diagram, you see high palm oil stocks, low premium. Very high palm oil stocks, the premium for 1 month was minus $10, $20. Just for 1 month. Then it bounced back. Low palm oil stocks, higher premium. They move opposite directions. So we start to get the picture. Petroleum sets the floor to the market, and the premium for palm oil in Europe over petroleum moves in the opposite direction to stocks. So when you hear that stocks have come down in Malaysia, you expect the premium to go up. When you hear that stocks have gone up in Malaysia, the premium should come down. That is what this diagram tells me. So, I summarize it here. Since 2007, we see that Brent crude oil has set the floor to European CPO, crude palm oil prices. And stocks in Malaysia now determine the premium for CPO over Brent. So that is really the message I want you to take. In the third paragraph, I point out this premium can change a lot. The peak was $300. That was 12 months ago. That was 24 months ago, in the middle of the year. And the floor is 0, which was about 6 months ago. So again, high stocks mean a low premium, low stocks mean a high premium. Now, that looks correct, it is correct, but what you want to be persuaded is, how is it that the price floor was defended in the face of the highest ever level of stocks in the world? Stocks were unprecedented. We've never had such high stocks. And the answer is partly that when CPO, I will explain this diagram, this is daily prices, when CPO in Europe equals the petroleum price, CPO in Southeast Asia, in Malaysia, in Indonesia, is below the petroleum price because of sea freight. Palm oil is exported from Southeast Asia to Europe, and so when it lands in Rotterdam, you have to pay the freight. The red line shows you daily the premium of the price in Rotterdam over crude oil. And you can see some days it was negative, and recently it has been around $100 a ton, the red line. The blue line shows you the local price of CPO inside Malaysia, delivered inside Malaysia. And you see that for 6 months, the blue line was negative, it was below zero. At that time, CPO was cheaper than crude oil inside Malaysia, which should mean that for somebody wanting to look at a fuel source to make diesel, at that time it was actually cheaper to make biodiesel and sell it than it was to buy diesel, because palm oil was cheaper than crude oil. Recently the blue line has been close to zero. So right now there is a kind of balance between the competitiveness in Malaysia of palm oil against crude oil. Now this is Malaysia. I then show you where the real action has been, which is Indonesia. In Indonesia, first the red line is the one I showed you before. That is for Rotterdam. Premium of the price of palm oil in Rotterdam over petroleum. The blue line is the FOB, is the export price from Sumatra to the world market. Its premium over crude oil. And you can see recently that has been $50. The one that is really interesting is the green line. Indonesia today has an export tax on palm oil. So when you export palm oil, you have to pay a tax which depends on the price. But what it means is the price inside Indonesia is below the export price by the amount of the export tax. Can you see that there was a time when the price inside Indonesia, the green line, was more than $200 a ton cheaper than crude oil? So you could make biodiesel, and it could undercut diesel by a very large amount. Then it bounced near $100. Recently it has been between $0 and $50. In Indonesia, without even needing a subsidy, for a long time, palm for biodiesel has been cheaper than crude oil for diesel. You did not need a subsidy to make biodiesel and blend it into diesel, because it was cheaper. That is why Indonesia, which had huge stocks of palm oil, we don't know the amount, all we know is it was huge. That is how they were able to absorb the surplus. It went without much publicity as a fuel. It became cheaper than petroleum. And that was the secret to the floor, to the CPO price, to the palm oil price. So, I say this again here. Freight costs and export taxes have reinforced the floor to the price band. There is no doubt, and that's important, that even without subsidies, even without mandates, palm oil became profitable as a fuel inside Southeast Asia because of freight. You had a freight discount to Europe, but also because of export taxes, which made the internal price in Malaysia, in Indonesia, below, even lower than the export price. So the local price was cheap, the export price was higher because of export tax, and then the price in Europe was even higher. And together, fuels, the biofuel market, converting palm oil into a competitor to petroleum, defended the floor. And my belief is this will now be a fact forever in the future. Palm oil will not fall in Europe below the crude oil price because you can convert it into a direct competitor to diesel. So let's now look a little bit forward to palm oil prices. The first thing you need to know when you look at production, this shows you monthly production in Malaysia and in Thailand. Thailand is measured on the right-hand side. It is about 1/10 the size of Malaysia as a producer. I just want to show you, which you probably know if you follow palm oil, every year there is a seasonal pattern. Production tends to rise in the second half of the year, come down in the first half of the year. If we look at this diagram, the same pattern is happening again this year, but production will from now be rising. So in the background, we know that production of palm oil in the next 6 months should be on a rising trend. I also thought it was interesting to show you Thailand, because Thailand has more of a dry season. Maybe it's a bit more like Vietnam in that way. You have a monsoon. Malaysia, you tend to have rain almost every month. As a result, you can see production fluctuates more. But you also see that recently, because of good rains, Thailand and Malaysia for the last 2 years have been moving together. So we have been, as a world, fortunate that the weather has been good for the last 2 years for palm oil production. But you see the seasonal pattern, production low in the first half year, rising in the second. And that will happen again this year. In the background there is another pattern we must know, which is the biological cycle. Trees can produce at a high level for a time, and then they produce at a lower level later. This is not monthly output. This is different from the other one. This is showing you year-on-year change in output. It shows you June production this year against June last year, May this year against May last year, April against April. Year-on-year change. And what you see is there is a pattern. Sometimes the trees produce a lot, then they rest, and they produce less year-on-year growth. And I've included Indonesia here. Indonesia against Malaysia, our estimate for Indonesia, because it's not published. I want you to see two things in this diagram. The first one is that the biological cycle is now moving towards lower growth year-on-year. The blue line, the red line are coming down. So the biological cycle is turning down when the seasonal production, which I showed you just before, is picking up in the second half year. So to some extent they move against one another. The other thing which is very important, can you see the blue line is higher nearly always than the red line? In Indonesia we've been having a lot of plantings going on. The haze we have read about in Malaysia, Singapore, is an example of people still planting oil palm because it's profitable. So you can see the trend in Indonesian production is higher than the trend in Malaysian production. But this biological cycle is there in the background. So if I'm looking ahead, just looking at the pattern, I just drawn arrows just to indicate. The biological cycle should be leading towards lower year-on-year growth in Indonesia and lower year-on-year growth give us higher production as we get towards September, October, November. And we have the biological cycle, which is reducing year-on-year growth. So, CPO, palm oil production, will be rising because of seasonal patterns, but year-on-year output growth is slowing. I just say that again there. What we also see in the third paragraph, which is important, is in the background when you are forecasting palm oil, we must remember that these high prices have really added to plantings in Indonesia and also in Thailand. So you are going to see, with a delay, production of palm oil picking up in Indonesia, Thailand, some in Latin America, some in Africa. Not so much in Malaysia because most of the suitable land is already planted. But in these other countries, high prices have encouraged people to plant. And these plantings, because it takes a long time, you will hear this I'm sure later, before palm starts to produce, there is a guarantee that production will go on rising quite fast for several years as these trees that are planted become mature. But the bottom line is palm oil stocks are going to start rising again from July. And that's going to be putting downward pressure on the premium for palm oil, the gap between palm oil prices and crude oil prices. Higher stocks bring down the premium. So, what are the lessons for you when you're making your own price forecasts? And actually, I suppose the lessons I think are simple. To do them maybe is harder, but the lessons are simple. First of all, and that's the hard one, and maybe outside we can talk about it, it's a big question. The first thing you need to know is what is driving petroleum prices. If you can predict that, you can predict the floor to the palm oil price. I have my own views, but maybe you don't agree with me, so we can, as I say, talk about it later. That's the most important thing to know. If you want a forecast of palm oil prices in 5 years' time, the first question I will ask you is, what is your forecast of petroleum? When you give me the answer, you will be surprised. Within 1 second, I can give you a price forecast for palm oil. So, petroleum is crucial. The next thing that you have to look at, because we need to know about stocks, is to look at the planting of oil palm in Indonesia. It's now the main driver of the growth in world palm oil output. It already produces 50% more palm oil than Malaysia. So it's a very big producer. And recently planted areas, especially in Kalimantan and Borneo, are going to keep that growth continuing. It's not easy to follow because there are no good numbers. But anyhow, you have to do your best to forecast what is happening in Indonesia. But for the short-term price forecast, keep a very close eye on the seasonal shifts in the output of palm oil and in stocks, because the stocks determine the premium, the gap between palm oil and petroleum prices. So, if I were asked, what is the direction of prices in the next few months? Stocks, I've just drawn a red arrow. Stocks will be going up on seasonal basis, and therefore the premium for palm oil over petroleum should be coming down. So it means if you think that the petroleum price will stay where it is today, I am saying the palm oil price will come down, because stocks will be rising. So, thank you very much indeed. Thank you.